And welcome back to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management, the show where we sit down and talk about you and your retirement and the stuff that you're dealing with and the stuff that Jay helps you deal with as he works your way through retirement. Jay, how are you doing today?
Back at it, talking about money, Randy.
Yes, indeed. And we're going to dive right into what's going on this summer in the market because I got headlines here that are negative. I got headlines here that are positive, and I'm going to lay it right at your lap and see what you can think about this. So right now, okay, summer months in the market are usually a little soft. People say it goes down 1%, maybe up to 3%. Then we have midterm elections. In years that we have that, same thing. Market seems to go down a little bit. Then, if you add in, we just got a new Fed chair, that really riles the market. When that happens, that could go down between 5 and 20%. So people are saying, whoo, this summer could be rocky. Well, then you've got AI and you've got all that's going on there. And I was watching some Fox Business and I saw Charles Payne and he was saying, hey, when the Micron report comes out, if it's really good, we've got a lot of room to run. This is going to be a great summer. And the Micron report came out gangbusters. So what do I do with all this, Jay? I mean, we got one side here. We got another side here. Am I being a market timer saying, get me out of this? What am I supposed to think about all this?
Yeah. So are you into astrology?
I know a little bit about it.
Yeah. I know very little about it. It was just a few years ago somebody told me like what my star sign was. I don't even know. Right? That's how little I'm into it. But I do know when they write those things, it's something like, hey, everything's going to be really great, but be careful because something could go wrong. Like, yeah, okay. I think it's the same guys who write our financial stuff, right? And because like it's a dynamic economy. Like that's always the way it is. And like, what I say to people, some people come in to us and unfortunately, usually this is people who have not done such a great job savings and they know they're behind and they know they need to catch up and they haven't been saving the way they should be, contributing to the 401k, or they've been invested very conservatively and they're a few years from retirement now and they say, hey, I want to invest with you guys. I want you to help me out. And I want to be real clear with you. I know I'm behind, so I need to get real aggressive with this and make as much money as possible, but I can't afford to lose anything.
Okay.
I said, all right, we can't help you.
Yeah.
Right? Like that doesn't exist.
Yeah.
And so, the thing to take away from all this is that's life in the stock market. If you can't handle that, it was, it wasn't Buffett. It was his right-hand man, Charlie Munger, who died, what was it, 6 months, 18 months ago? I don't know when it was.
Yeah.
Right? And he said, he was a little bit more of a less sugarcoat kind of guy than Buffett was or is. And he said, hey, if you can't handle a 50% pullback in the market, you shouldn't be investing. And that's a pretty tough one to accept, isn't it?
That's kind of extreme.
Yeah. And he's probably being like over the top with that. Like, I get it. But the point he's making is right. Like, if you can't stomach seeing major volatility in your portfolio, it is not the place for you. Okay. That's part one. Part two to that is then also that's why you shouldn't have everything in that bucket. So we talk a lot about people that are transitioning from work life and that kind of mindset, and maybe they've been in that mode for 30, 40 plus years, and it's been save, invest, be as aggressive as you can. This is the time to grow the money. And then the pivot to retirement, and that same method of what got you to there will not work very well through your retirement.
So you and I have talked about the different levels of money that you could put in the market. And when people think of the stock market, they think of heavy risk. There are, I mean, if you had, I'm just going to throw something up here. Okay. So if you had a 20% risk in the market and 80% in bonds or in, fixed income, something like that, if the market goes down 50%, you only go down 10. And that means you can probably recover from that. And so it's kind of a level of how much do you want to dip your toe into that pool? Do you want to go in a cannonball head first, or what do you want to do?
Yeah.
You could dip your toe in there too. So being in the stock market doesn't have to be associated with heavy risk, does it?
Yeah, and that's the question we get a lot from people is like, well, could I lose all my money? And my job is to be as clear as possible. We are in the world of no guarantees, right? That's where we are, all right? So the word guaranteed when we're investing in stocks and the markets and stuff like that, the word guaranteed does not exist. Now, for you, if you are invested in a diversified manner, for you to wake up and you've lost all of your money in one day, like what's happened? Like the world's come to an end, right? Like the 500 biggest companies in the world have gone out of business overnight. That doesn't mean they can't be down 20%. It doesn't mean they can't be down 30, 40%. And it comes back to, what we always say. Do you want to have some of your money that's not at risk? Probably that's a good idea when you're in retirement, right? And what a great example of what you brought up, you said, hey, if we have a little bit there and the market's down, but we've got bonds. This is why we emphasize so much that we are in the world where guarantee does not exist when we're investing in managed money, okay? Because that theory that everybody had, because we get a lot of people in the office, it's like, yeah, I know I could have done better over the years. I've been in bonds. I could have made more money in the market, but at least I can't lose money in bonds. And that's not accurate, right? All we have to do is go back to 2022, and the whole thing that was supposed to hedge your equity portfolio, which is the bonds, they lost money too.
Yep. And
it didn't matter where you were, right? You were taking a hit. And so having that diversification, not just within your investment portfolio, but in your overall wealth allocation is so important.
So you got to ask yourself this question. I bring up questions you can sit down and talk to Jay about, but if you look at yourself in the mirror and say, how much do I want to be in the stock market? And then the question is, how much do you need to be in the stock market? There's your question. That's what you really need to know. And let's sit down and talk about how much you need to use that stock market. How much growth do you need? Maybe you're coming in with a pension and a nice Social Security, and we don't need to mess with that stock market that much. Maybe it's the opposite. Who knows? Let's sit down and talk through your retirement math. It's a no-cost, no-obligation look at your retirement. If you start at the website, which is retire210.com, there's a place for you to put some information in there. The team reaches out to you and just basically starts the conversation. It's really what it is. And you can also find Jay's book down there at the bottom of the page. Just scroll all the way down to the bottom. You can download one chapter from the book. And if you want to come in for a meeting, it'll give you the whole book there as well. So here's the number to look into it and to sit down and talk to the folks at Secure Financial Management. 210-985-6200. 210-985-6200. Well, they talk about how much money all the baby boomers have, but if you take a look at all the money that people put in 401ks and retirement accounts all across the country from people ages 20 all the way to 90, okay? How much do you think is in there? It's a big number. It's $50 trillion.
Jeez, I think last time we talked it was 40 trillion.
Yep.
My word.
Yep.
Yeah.
$50 trillion is in retirement accounts. Now, if you look at that $50 trillion, only 2% of it has been dedicated to protected income, which I find very interesting because if the number one fear is running out of money, you would think that everybody would be clamoring to find that fixed protected income like a pension, like Social Security, that would be coming in. But that is not the case. So when you sit down with your clients, we talk about, building that paycheck for retirement. How much of their money is going to be dedicated to that? I mean, if we look at it like a pie shape, I don't know. Do people have that protected income when they come in the door with their assets, or does that need to be created?
No, nine times that. So we've talked about kind of the death of the pension for some time, haven't we? And the clients that we have coming now are late 50s, early 60s, and they often very nostalgically think about their parents' retirement. They're like, well, they had it easy because they got a pension and they got Social Security. And then when the discussion comes to, well, we can kind of recreate our own pension income, It's, well, I really want to grow this money. It's like, well, guess what? Those are two different things.
Yeah.
And you need to decide, are you still in growth accumulation mode, which is really what most retirees have been doing for the prior 30, 40 years, right? Or are you now in, how do I make this money work for me? And by the way, I don't want to be up at night wondering if Trump's going to put a tariff on someone and my investment's going to be down 20%, right? So it is about coming to that acceptance with yourself that, hey, the role of what my money is supposed to do has now changed. The job I gave my money during work was go out there and grow as much as you can. Right? That's what I want you to do. Go out there. I'm going to allocate you to this aggressive portfolio. Grow as much as you can because I want to retire it someday and I need to use you. All right? What comes with that is a 2008 event. Yeah. Stinks, right? No one likes to see it. Guess what? You weren't using your money then anyway. It was doing what it was supposed to do. It was in the aggressive allocation. And the way you got paid for that back over the last whatever has it been now, 15 years, 16, 17 years since then, has been multiple hundreds of % of return in the market. It did its job, right? Its job is not that anymore. The money's job is not to go out and grow and take big tumbles and falls and then ultimately grow more later. Its job now is to provide income for you for the rest of your life. That's where most people's mindsets should be. Some people aren't there, but if that's not what your money's doing for you in retirement, then what was the point of it?
Yeah. You're saving all this money. You're pounding it into that 401k. You're putting it into a Roth. You're buying properties. You're doing all this stuff. Now you're here. You're here at the retirement when this stuff is supposed to pay off for you. And you're looking at it. You're going, it's not like a pension. It doesn't just kick off a paycheck. What do I do with this?
Right.
And when you sit down with Jay and the team, that is the discussion. How does all my work in retirement make me money in retirement, fund my lifestyle, make me do the stuff I want to do, the cruises and the trip across the country and spoiling the grandkids and helping them with college and doing all the stuff you want to do? How does that work? That's a meeting with Jay and the team at Secure Financial Management. It's no cost, no obligation. Let's sit down and actually have that meeting. 210-985-6200 is the number. 210-985-6200. Get on the calendar. Let's do the math on your retirement. Even if you're a couple of years away from retirement, let's figure that out. If there's a gap in there, let's get that gap filled before you actually retire. The website is retire210.com, and you'll see Jay's book down there, far down at the bottom of the page. Scroll all the way down there, and you'll see Wall Street's Game. And you can download a chapter from the book. You come in for a meeting. We'll give you a copy of the book. This is a book that kind of shows you what you're up against when you go into this retirement place and the financial services industry and all that's going on there. It's a whole new world, and you kind of need a guide to get you through it. Again, retire210.com or 210-985-6200. Baby boomers, the oldest ones are now 80. The youngest ones are now 62. So guess what? The entire baby boom generation is now in retirement range, okay? So this whole demographic fear that we've had that as soon as all the baby boomers move into retirement, they're going to start taking all their money and the market's going to crash. It hasn't happened, okay? It's just not going to happen. So people are so worried about the big one that we're going to have another 2008, something like that's going to happen. It just hasn't materialized. So my question to you, Jay, is, are we worried too much about the big one and not worried about some of the other aspects that could really get in our way in retirement, taxes and things like that? So what would that be?
Yeah. So when we talk about the big one, we're talking about a 2008 level sort of event, right? Well, unfortunately, the problem is with those, you don't know when it's going to happen, right? So anyone who's out there predicting it, and I've seen the same thing. There's a geopolitical analyst I follow a lot on YouTube. Really interesting guy. Talks about all sorts of different stuff, like demographics in China, war, and all global sorts of events. And he's been talking for years about the exact same thing. The market. And he wouldn't be a boomer. He'd be an older Gen Xer, I guess. And he's been the same. Hey, all the boomers are going to retire. They're going to take their money out of the out of the stock market and they're going to put it into guaranteed income and annuities and bonds and CDs and all sort of stuff. And it hasn't happened. And a lot of the stuff he says is interesting and he's right. But on that one, I knew you're not right because I see it on the ground level. And we've talked about it before, Randy, is that, the first thing is anyway, when people retire, it takes them a while to get out of that mindset of growth, right? And kind of pivot into, hey, my money's job for the last 30, 40 years when I was working, I was sending it out to grow. Go and grow, be invested. Yes, it's aggressive. Yes, it's risky. There's going to be ups and downs in the market. It doesn't matter. I don't need you for a while. Go and keep working. And now that money's come home and we've pivoted to retirement, and it takes a little while for people to accept, well, wait a second, that's not the job of my money anymore. It's not the job of my money is for it to not grow. Now, do you have no growth? If you got enough money, we should be doing several things. Like, let's have some of it that's safe. Let's have some of it generating income. Sure, let's have some of it that grows. And this is the big thing I think they miss as well, is let's just say a big portion of that money does leave the markets and it goes to safer things. Typically, those are some sort of annuities, right? It could be fixed annuities, fixed index annuities, income, whatever it is. Well, those are all done through insurance companies. What do the insurance companies do with that money?
Put it in the market.
They go and invest it. Okay. Yeah. So it's this circular thing. Yeah. If it comes out of this bucket, it goes to the insurance company. Well, how do you think the insurance company is giving you these guarantees? They've got to go and invest it somehow. They've got to generate some sort of income. So the money flows around. Now, that's not to say, are we going to have an economic slowdown? The market loses 20%. Oh, that's part of life, right? That's part of investing. But I couldn't agree with you more. Is this whole what's the other big fear that comes up? You just said that the youngest baby boomer is 62.
Right.
The first thing I thought, you said, hey, they're all in that retirement range. The first thing I thought is, they're all in the Social Security eligibility zone.
Right. Yeah.
Right. Yeah. Okay. So we hear the thing for Social Security as well is, we're going to run out of Social Security money. The math is the math. Are there plenty of things they can do to fix it? We've talked about it all the time, right? I don't know what it's up to now, but it's something like the first 180,000 or 200,000 or whatever it is of income. That's the only part that's taxed for Social Security. So anybody out there making 250, 300, 400, 500, etc., they're not paying Social Security tax on that extra. Could they change that? Wouldn't surprise me if that's on deck to come up, right?
Yep.
We talk about this one all the time. Your retirement age, your full retirement age, my full retirement age, and my 1-year-old's full retirement age are all the same.
Doesn't make sense.
Bananas, right? Is that something that's probably? Right. So a lot of these problems, there are solutions to them. Now, is there any politician that actually wants to go out and do it? No. Right. But, when it comes to the 11th hour, do they have levers to pull on? Yeah.
Yep. And we hopefully will see some of those levers being pulled in the next couple of years. You're listening to Clear Skies Retirement with Jay Kirkwood. And if it's time to talk about your retirement, let's get that conversation underway. It's 210-985-6200. 210-985-6200. It's a no-cost, no-obligation look at your retirement. Really, it's a conversation. It's just saying, hey, I'm coming up on this. I see my friends retire. I see my coworkers retire. I wonder how this is all going to turn out for me. I'm kind of concerned about A, B, and C. Let's get those questions out there right now. 210-985-6200 or retire210.com. Well, we talk a lot about 401ks here on the show because a lot of people are going into retirement with their 401ks. And Motley Fool says if you're going into retirement with just a 401k or just an IRA, you're making a huge mistake. They want you to diversify into other places. So, Jay, why would they say that? What is the downside of having all your money into a 401k?
Yeah, what they're getting at here is most 401ks don't give you an option outside of the markets. Right? Yeah. Can you go into fixed accounts and stuff? Well, yeah, but there's still bonds underlying those fixed accounts, right? They're not giving you options to generate pension-like guaranteed income. And that's what they're really getting at here is anybody who's taking a non-emotional, objective view to how you survive retirement, right? How do you get from 60 to 80, 85, 90, whatever your life expectancy is, without having major crises along the way, is you have a certain amount of guaranteed income that's not going to be reliant on the markets. Forget about, we've talked before that, there's this prediction, there's going to be this huge crash because all the boomers are taking their money out of the markets, and we're like, yeah, that's probably not going to happen. Something's going to happen. Right, there will be something, right? If there's not another 2008 mortgage crisis thing, it's not going to be that. It's never the same thing. It's something else, right? Could there be oil shocks? Could there be an unexpected war? Could we have interest rate rises when we're not expecting them, and it causes a stumble in the market? Yes. And the real killer with that, we probably haven't talked about this enough on the show, really, Randy. The big killer with retirement income that is fully dependent on unsecured sources is something called a sequence of return risk, right? And you and I have talked plenty of it offline, but we haven't really talked about it on the show, and we should, because I think when a lot of people listen to this, it's like, yeah, but I survived 2008 and I was fine. I remember the start of the 2000s, and there was 2 or 3 years back to back, around the September 11 timeframe that were pretty nasty, and I survived just fine. Yeah, you were in a completely different economic environment at that time than you are now in retirement. You could almost think about all of those events as opportunities for you while you were working, because when you were working, hopefully you were contributing to your 401k. Did it go down? Yeah. Did that stink? Yeah. At that point, it's just a number. It's just a number on a screen. And you keep contributing, your employer keeps contributing, you're buying at a discount. It worked out well for you. Now that same event actually works incredibly negatively in your favor. Because let's take the person who retired, and I'm not going to get these dates exactly right, but you're going to get the point, right? Let's take somebody who 25 years ago, could you imagine a better retirement date than December 31st, 1999? I'm going to start the new millennium retired.
Yep.
And I've done a great job of savings. The 80s was pretty good for the markets. The 90s were just, killer for the markets, and your 401k is just golden, right? What could go wrong? Well, 2.5 to 3 years of negative market returns are about to hit you, and you don't know, right? And this time, it's not in your favor, because not only are you not contributing, you're actually drawing down. So you're drawing down on an investment account while it's losing money as well. And even just forget about the drawing down of the investment. And just side note, that's what we call sequence of return risk, right? Is I retire, we have a negative year, I also need to get money out of my account, I'm selling at a loss. Well, the next year it should be up. Not then, it wasn't. Didn't happen then. Again, back to back. And that individual has suffered a series of events that they're not going to recover from.
Right.
They are permanent negatives on that investment account that can't be recovered from. And it was really caused by the whole eggs in one basket scenario, right? We didn't diversify. Our mindset had not changed from our growth era back when we were working to acknowledging I am in a different role now. The job of my money is now different. There was no pivot. It's disastrous and it's unrecoverable.
And it's the one thing that we are all really afraid of is you get into retirement and the market tanks. So that means we have to position our money in a place that if that does happen, we don't have a lasting effect for the next 20 years. That is a financial plan. That is a retirement plan. And that's what Jay and the team at Secure Financial Management are offering. Give them a call. It's a no cost, no obligation look at your retirement. Let's sit down and talk about, are we a good fit for you? Are you a good fit for the team at Secure Financial Management? Let's sit down and find out. Retire210.com is the website. You can put a little information in there and the team reaches out to you. or you can reach out to the team. It's 210-985-6200, 210-985-6200. And remember to have this podcast delivered straight to your favorite podcast platform by hitting like, follow, or the subscribe button. Thanks again for listening to Clear Skies Retirement, and we'll see you next time.
Investment advisory services offered through investment advisory representatives at Secure Financial Management, a registered investment advisor. Exposure to ideas and financial vehicles discussed are not designed nor intended to be applicable to any person's individual circumstances. It should not be considered as investment advice, nor does it constitute a recommendation that anyone engage in or refrain from a particular course of action. Past performance is not a guarantee of future results. Investments can fluctuate, and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Secure Financial Management is licensed in your state, please contact their office. Secure Financial Management is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Wholesalers Insurance. Jay Kirkwood, Texas Insurance License number 1421850.